Okay, so you're here because, let's be honest, you want to get to the bottom of some pretty complex stuff.
Right.
Like you want the insights without drowning in information overload.
Exactly.
That's kind of our specialty here on the deep dive, right? So today we're diving deep into, well, frankly, the always kind of mysterious worlds of investment and speculation. And we've got some seriously heavy-hitting sources to guide us. We've got Burton Malkiel's A Random Walk Down Wall Street, of course.
Classic.
Then there's Edwin Lefebvre's Reminiscences of a Stock Operator. That's a fascinating one. John Kenneth Galbraith's The Great Crash 1929. And no deep dive into investing would be complete without Benjamin Graham's The Intelligent Investor, right?
Absolutely foundational.
So our mission is simple. We're going to distill all this wisdom into actionable knowledge and give you that historical context that you need to really navigate the financial world.
Think of it as a crash course in like decades of financial wisdom, but tailored for, the modern investor. And there's no better place to start than with a concept that Benjamin Graham, he considered it absolutely essential, the difference between investing and speculating.
Right, and this is really a core concept that a lot of people kind of get confused by.
Yeah.
So Graham, as kind of, the godfather of value investing, he had a very firm line between these two.
Right.
He saw investors as being these diligent, almost detective-like individuals. They're looking for those sound businesses at prices that make sense.
Right.
Whereas the speculator, they're really trying to kind of like predict and profit from those short-term, swings in the market.
Precisely. I think it really comes down to your primary motivation. Are you in it for the long haul, for the steady growth of a solid company, or are you looking for a quick buck based on market whims?
Yeah, it's a really important distinction, and I think it's really easy to get caught up in, especially when markets are going up and up and up. It's easy to kind of think you're a genius.
Yeah.
And maybe stray from those core principles. But this kind of leads us to another major theme that we see again and again in these books: the rise and fall of speculative bubbles.
Yeah.
And I don't think we can talk about bubbles without thinking about the NASDAQ Q bubble of the late 90s, early 2000s, right?
Yeah.
That index, it basically tripled in value in just over a year.
Yeah, it was a wild time, to say the least. Some of those price-to-earnings ratios, they were just astronomical, completely detached from any reasonable measure of value.
Yeah.
And it's easy to think that, it's, ancient history, right? .com bubble, who cares? But what's interesting is that even seasoned professionals can get swept up in that kind of frenzy. Malkiel, he points out that even Goldman Sachs, during the peak of the dot-com boom, they kind of downplayed the fact that a lot of these internet companies were just burning through cash.
Right.
They were like, oh, it's just a sentiment issue, not a fundamental risk. Well, guess what? A few months later, sentiment shifted big time, and hundreds of those very same companies, they went bankrupt.
It's almost ironic how right they were, just on like a much faster time scale than they had.
And the repercussions, they were huge. You had those celebrity analysts who were like cheerleading for these high-flying stocks. They faced public anger, legal challenges, regulatory scrutiny. Trust in Wall Street, it took a massive hit.
Yeah, absolutely. And, I think one thing that Malkiel does really well is he connects this specific bubble to the broader historical pattern.
Yeah.
These asset price bubbles, they happen over and over again, and they always seem to end in a pretty similar way.
Yeah.
Especially when they're fueled by, a lot of easy credit and people borrowing a lot of money, which is something we saw, again, with the U.S. housing crisis in the early 2000s.
Right.
You get that cycle of, prices going up, lending standards getting looser and looser, and people just taking on more and more debt, and it creates this, incredibly vulnerable system.
Yeah, it's like a house of cards just waiting for a little puff of wind to knock it down.
So given this recurring history of, booms and busts, how do experts even try to make sense of, the movements of the market? Well, there are basically two main approaches that come up a lot in these books.
Right.
And those are technical analysis and fundamental analysis. So let's start with technical analysis. I think a lot of people are familiar with the idea, looking at past stock charts, trading volumes, trying to identify patterns.
Yeah, it's all about finding those signals in the noise, right? The idea is that if you can spot these repeating patterns, you can predict where the market's going to go next.
Right.
And a lot of technical analysts, they believe that market psychology is a much stronger force than, logic or fundamentals. It's all about those collective emotions, fear and greed.
Right. Right, and that kind of reminds me of what Malkiel calls the castle in the air theory, right?
Yeah.
It's almost like, stocks are worth whatever people believe they're worth.
Right. It's kind of like a self-fulfilling prophecy in a way. If enough people believe a stock is going up, it will go up at least for a while,
Right.
regardless of what the actual underlying company is doing. And if you subscribe to the weak form of the random walk hypothesis, which is this idea that past price movements, they don't really tell you anything about future returns, well then, as the economist Richard Quant put it, technical analysis starts to look a lot like astrology.
Ouch. That's a pretty harsh comparison.
Yeah.
But it does raise the question, though, if past performance isn't a reliable indicator, then what's the point of studying all those charts, right? I mean, Malkiel's research, it suggests that consistently beating the market using technical analysis, it's incredibly difficult.
Right. It's not to say that no one ever makes money using technical analysis,
Yeah.
but you have to remember that for every winner, there's a loser on the other side of that trade. And when you factor in transaction costs taxes, the odds of consistently outperforming a simple buy and hold strategy, they get pretty slim.
Right, so it's a tough game to play. Now let's talk about the other side of the coin, fundamental analysis. And this is where, you really get into the nitty-gritty of a company's financial health and prospects.
Yeah. This is where you're looking at the company's financial statements, their earnings, their assets, their management team, their competitive position. You're trying to figure out, what is this company really worth? What's its intrinsic value?
Right. And this seems like, much more logical and, kind of grounded in reality.
Right.
But, even with this approach, it's not like a guaranteed path to success, right?
Mm-hmm.
Our sources, they highlight some pretty, sobering realities about, how good even professional analysts are at, predicting the future.
Right.
I mean, it's amazing how consistently security analysts struggle to predict even like next quarter's earnings accurately,
Yeah.
let alone like 5 years down the road.
Yeah.
And Malkiel, he points out that this isn't just for, those volatile tech companies.
Right.
It's even true for, those supposedly stable and predictable industries like utilities.
Yeah.
So it really highlights the inherent difficulty of trying to foresee the future of any business, really.
Yeah, it's like trying to predict the weather 3 months out. You're going to be wrong more often than not. And it's not just predicting company performance, but also identifying those star investment managers, the ones who can consistently beat the market.
Right.
Even the most celebrated funds, their track record over the long term can be really inconsistent.
Right. And we see that again and again.
Yeah.
Right. Funds that have amazing returns in one decade, they kind of fade into mediocrity in the next.
Yeah. It's like that basketball player who has
Yeah.
a hot shooting streak, Sooner or later, they're going to cool off. And the same thing happens in investing.
Yeah.
This tendency for things to kind of go back to the average, it's called regression to the mean, and it's a very powerful force in the investment world. The Mates Fund example, it's a really stark illustration of this.
Yeah.
It was the #1 performing fund in 1968.
Wow.
By 1974, it had lost 93% of its value. That's a huge swing.
It's a good reminder that past performance really is not indicative of future results.
Yeah.
And even Peter Lynch,
Yeah.
who managed the Magellan Fund with incredible success for a long time, he eventually retired relatively early.
Yeah.
And that kind of shows that even the best of the best, they can't defy gravity forever.
Right. And it's important to remember that this whole phenomenon of, market manias and herd behavior, this isn't something new. Malkiel, he references Charles Mackay's book, Extraordinary Popular Delusions and the Madness of Crowds, which, it reminds us that speculative bubbles, they've been around for centuries. I mean, think about the South Sea bubble in the 18th century.
Right.
It's a classic example of how irrational exuberance can take hold of an entire society. People were buying shares in a company that had no real business plan, no profits, and they were willing to pay ridiculous prices.
And it all came crashing down
Yeah.
eventually. And that brings us, really to the really important role of investor psychology. We're not always the rational actors that we like to think we are, especially when it comes to money.
Oh,
Overconfidence, that's a big one, right?
huge.
People think they have some special edge, some insight that allows them to beat the market. And this often leads to, excessive trading, excessive risk-taking.
Right, and there's a great study by Odeen and Barber that Malkiel talks about. They found that on average, the more frequently individual investors traded, the worse their returns were. And there's even a gender difference. Men tend to trade more often with worse results than women.
Oh, really? That's fascinating. So, even when these irrational behaviors, they kind of push prices away from any kind of sensible valuation.
Right.
The market doesn't always correct itself immediately.
Yeah.
And I think, we hear this term thrown around, limits to arbitrage.
Yeah.
Can you explain what that means in practice?
Yeah, sure. So even when you have these professional traders, these hedge funds who recognize that an asset is mispriced because of, irrational investor behavior,
Mhm.
they can't always step in and correct it quickly or even effectively.
Right.
They face all sorts of constraints, limited capital, they have risk management rules they have to follow,
Right.
and sometimes the irrationality, it can persist for a lot longer than they expect.
Right.
So you could have a stock that's clearly overvalued, but it just keeps going up and up because of, hyper momentum.
Yeah.
A hedge fund might try to short that stock bet on its decline, but if the hype continues, they could lose a lot of money in the short term. And they might even be forced to close out their position before the irrationality finally corrects itself.
Right. So if predicting the market and, consistently picking winners is so difficult, what are some of the other investment strategies that our sources kind of, touch on? We hear about things like smart beta, for example.
Yeah, so smart beta is basically an attempt to do better than those traditional market-weighted indexes,
Right.
like the S&P 500. And the way they do this is not by picking individual stocks, but by tilting their portfolio towards certain characteristics, factors that have historically been associated with higher returns.
Right.
So things like value, size, momentum.
Right.
And the idea is to try and capture some of the benefits of active management, but in a more rules-based and potentially lower-cost way.
Right. But it sounds like the results of these smart beta strategies have been kind of mixed, right?
Yeah. Malkiel, he points out that a lot of these funds, they haven't consistently delivered those, excess returns that they promise. And sometimes they can even be less tax efficient than just, owning a broad market index fund.
Right. And another interesting strategy that Malkiel discusses is Treasury Inflation Protected Securities, or TIPS.
Yeah, those are really interesting, especially in an environment where inflation is a concern. Because the principal value of TIPS, it adjusts with inflation.
Yeah.
So it's a way to protect your purchasing power.
Kenny guarantees that you're not going to lose ground to inflation. So kind of shifting gears a little bit, both Benjamin Graham and Burton Malkiel, they talk a lot about the importance of your time horizon when you're thinking about risk.
Right.
It's not just about how volatile an asset class is,
Right.
but how long you're planning to hold those investments.
Exactly. Your staying power in the market. That's
Right.
key.
Right.
So, for example, stocks might have higher returns over the long run, but they can also be more volatile in the short term.
Mhm.
If you're investing for decades, you can ride out those fluctuations. But if you need the money in a few years, well, then you might want to consider something more conservative like bonds or even cash.
Right. And for people who are kind of gradually building their portfolio over time,
Right.
there's this technique called dollar cost averaging, which is basically you invest a fixed amount of money at regular intervals. So every month, regardless of whether the market's up or down.
Yeah, it's a great way to take the emotion out of investing, and it helps you avoid that risk of investing a big lump sum right before a market crash, because you're
Yeah.
buying more shares when prices are low, fewer shares when prices are high.
Right. It's kind of like smoothing out the ride a little bit. So, we've discussed a lot of the complexities and challenges of, trying to beat the market. But Malkiel and Graham, they both point to the strategy that seems almost too simple, investing in low-cost, broadly diversified index funds.
Yeah.
I mean, it sounds almost like a no-brainer.
Yeah, it is. I mean, look at the historical data. The S&P 500 index, it's outperformed the vast majority of professional money managers over the long run. And by investing in a low-cost index fund that tracks that index, you get instant diversification. You don't have to try to pick winners, which, as we've seen, is incredibly difficult to do consistently.
Right. Okay, so let's move on to Edwin Lefebvre's Reminiscences of a Stock Operator. Now, this book is written as a fictional story, but it's widely understood to be based on the real-life experiences of Jesse Livermore, one of the most legendary stock traders of all time. So what kind of timeless principles can we extract from, his journey?
Well, one thing that Lefebvre really drives home is that human nature, it doesn't change. The same emotions, greed and fear, they drive market behavior today, just like they did 100 years ago. One of the key lessons from Livermore's story is that you want to trade with the trend. Be bullish in a bull market, bearish in a bear market, don't fight the tape. And always be ready to adapt and react quickly to changing conditions. But he also learned some very painful lessons about the dangers of letting emotions cloud your judgment.
Right. Anger, desperation, greed, those are all recipes for disaster in the market.
Yeah. Mastering your psychology is just as important as understanding the technicals or the fundamentals.
Right. Livermore's early experience trading in bucket shops is a good example of this.
Yeah.
Those were essentially, illegal gambling dens disguised as brokerage houses.
Yeah.
He was making a lot of money, but he realized that beating the bucket shop wasn't the same as beating the real market.
Right.
He was just exploiting the flaws in their system.
Yeah, and there's that great anecdote in the book about this old trader, old Mr. Partridge.
Yeah.
And all he ever said was, well, this is a bull market. It was his way of reminding Livermore to focus on the big picture, the major trend, not get distracted by those little ups and downs.
Right. Livermore also used some, pretty unconventional strategies, like
Yeah.
buying stocks that were breaking out to new highs.
Yeah.
Because he noticed that a lot of times those moves, they signaled further upward momentum.
Right.
But ultimately, his biggest realization was that you have to study, you have to analyze, and you have to think to yourself, you can't just rely on hunches or tips. You have to understand the broader economic and market forces at play.
Right. He moved beyond just betting to really understanding the probabilities and the risks involved, and he stressed the importance of managing your risk carefully. Don't go all in on a single trade. Gradually build your position as the market moves in your favor, and only increase your bet when you're already winning. He also cautioned against buying a stock that's lagging behind the leaders in its sector. If a stock isn't participating in the rally, there's probably a reason for that.
Right. It's a good sign that something might be wrong.
Yeah.
So now let's shift gears again and talk about John Kenneth Galbraith's The Great Crash, 1929. This book, it gives us a really, vivid and insightful look into the events that led to that devastating market collapse.
Yeah, and one of the key dangers that Galbraith highlights is margin buying, essentially buying stocks with borrowed money.
Right.
And this was rampant in the lead up to the crash. It allowed people to participate in the market with just a fraction of their own capital, which amplified their gains, but also amplified their losses.
Right.
And the crazy thing is that these margin loans were seen as relatively safe because they were backed by stock.
Right.
But when the market started to fall that leverage, it worked against everyone. People were forced to sell to cover their margin calls, which drove prices down even further.
Right. And it seems like the Federal Reserve's response to all this speculation, it was pretty slow and maybe not as effective as it could have been. Galbraith, he mentions, they're kind of hesitant in small increases to the discount rate.
Yeah, and it's interesting because a lot of the money that was flowing into the stock market, it wasn't coming from traditional banks.
Right.
It was coming from corporations, wealthy individuals. They were making these call loans directly to brokers.
Right.
And the Fed, they didn't really have much control over this shadow banking system. So their ability to kind of rein in the speculation was limited.
Right. And then you had these investment trusts, which
Yeah.
were like the early versions of mutual funds.
Right.
They also kind of, amplified market sentiment both on the way up and the way down.
Yeah, they were essentially pools of money that were invested in stocks. And when the market started to tank those trusts, they had to sell their holdings to meet redemptions from investors.
Right.
Which put even more downward pressure on prices. And it's really striking how even the most respected economists of the time, they failed to see the crash coming. They were making all these optimistic predictions about the future of the economy and the market. Galbraith, he gives the example of Professor Kemmerer, who is considered like the leading economist of the day. And he was completely blindsided by the crash.
Right.
It just goes to show you that even experts, they can be wrong, especially when you're in the middle of a speculative bubble.
Absolutely. So let's return to Benjamin Graham and glean some final, kind of core principles from The Intelligent Investor.
Yeah.
He made this really interesting observation that the death of a bull market can actually be good news for long-term investors.
Yeah, because when prices come down, it creates opportunities to buy great businesses at much more attractive valuations.
Right. And Graham, he consistently warned against relying too heavily on past market performance as a predictor of future returns.
Right, especially those overly optimistic forecasts that were so common during the tech bubble.
Right.
He always emphasized that the value of an investment is determined by the price you pay for it.
Right.
Pay too much, and even a great company can be a bad investment. And of course, a core principle of Graham's philosophy is the margin of safety,
Right.
which means buying securities at a significant discount to their intrinsic value.
Right.
It's like a buffer that protects you against potential errors in your analysis or unforeseen events. For the defensive investor, Graham recommended a very conservative approach to bonds, sticking to high-grade bonds,
Yeah.
U.S. savings bonds, short-term corporate bonds, or even just keeping money in a savings account as cash.
Right.
He even pointed out that long-term bond prices, they can actually decline sometimes if interest rates rise, which might surprise some people who think of bonds as being very low risk.
Right. He was also a big believer in dollar cost averaging into a diversified portfolio of index funds,
Right.
which is a great way to avoid trying to time the market.
Yeah.
And when it came to picking individual stocks, he generally preferred those kind of, unloved but financially sound large companies that were trading at reasonable valuations. He wasn't a big fan of chasing after those high-growth, high-flying stocks, which he considered too speculative.
Right. He saw those as much riskier for the average investor.
And I think one of the key things that Graham stressed is that the intelligent investor, they shouldn't get too caught up in the day-to-day fluctuations of the market.
Right.
They should see those fluctuations as opportunities to buy low and sell high. But otherwise, their focus should be on the dividends that their stocks are paying and the long-term performance of the underlying companies.
Right. He also cautioned against trying to pick mutual funds based solely on their past returns, and he advised investors to really do their due diligence when choosing an investment advisor. Make sure they have a fiduciary duty to act in your best interests, and that they have a clear and sound investment philosophy.
Right. And he pointed out some red flags to watch out for when you're evaluating company management. Things like excessive CEO pay or the practice of repricing stock options.
Right.
Those can be signs that management is not really aligned with the interests of shareholders.
Exactly.
And he was also wary of companies that repeatedly split their stock just for promotional purposes
Right.
without actually creating any real value.
Yeah, it's just a way to make the stock price look more appealing to unsophisticated investors. And Graham, he even illustrated his concept of undervalued stocks by talking about his net current asset value approach, where you can sometimes buy a company for less than the value of its liquid assets,
Right.
which provides a huge margin of safety. And he also touched on convertible securities, which are kind of hybrid investments.
Right.
They have characteristics of both stocks and bonds, but they often come with their own set of
Yeah.
drawbacks.
So after this deep dive, into all these foundational texts,
Okay.
what's the core message that you hope our listeners kind of take away?
Well, I think the big takeaway is that building wealth, it's not about getting rich quick. It's not about trying to time the market or pick the next hot stock.
Right.
It's about understanding the difference between investing and speculating. It's about learning from history, being aware of your own biases, and taking a disciplined long-term approach. And for most people, the simplest and most effective way to do that is to invest in low-cost, broadly diversified index funds.
I think that's a really powerful and concise message and kind of leaves us with this final thought for you, our listener.
Yeah.
Which of these historical insights and investment principles kind of resonates most strongly with you and your own financial situation and goals? How can you apply these lessons to build a more resilient portfolio and a more informed approach to investing? We encourage you to go back and revisit these classic sources with these insights in mind and really dig deeper into those ideas that resonate with you.
Yeah,
And as always, if there are any other topics or books that you'd like us to deep dive into,
right.
please let us know. Thanks for joining us today.
Thanks for having me.